Hello, and welcome to the Papaya Academy. I'm Rebecca Hackworth, Head of Payments Content at Papaya Global, and I'm going to talk a little bit about how stablecoins work. While these digital assets have been around for a decade, you may have heard of them in the news recently. Stablecoins used to be the method of choice to park your dollars, euros, or yen on the crypto exchanges when buying or selling cryptocurrency. Now, stablecoins are mainstream, used by financial institutions, payments companies, and businesses to move money efficiently across borders. Stablecoins use blockchain technology and in doing so offer instant, secure, and final settlement without the challenges of pre-funding. If you didn't understand what that meant, you will by the end of this short session, I promise. So today, I'll cover what are stablecoins, the different types of stablecoins, the technology behind stablecoins, the applications and use cases for stablecoins, including paying workers abroad, and some regulatory considerations. So now, let's get stuck in. Simply put, stablecoins are digital currencies designed to maintain a stable value. They are usually pegged one-to-one to a reserve asset or a fiat currency. For example, one stablecoin will equal $1. By linking to an underlying asset, stablecoins act as a voucher that can be exchanged for fiat. The total supply of stablecoins is growing. In early 2025, stablecoins reached a market capitalization of $211 billion. Today, the largest stablecoin is Tether USDT, which is worth $140 billion in market value. The second largest is USD Coin, or USDC, by Circle, with over $50 billion in circulation. Not all stablecoins are engineered the same way. Fiat-backed stablecoins, these are backed by reserves of traditional currency or fiat, or equivalent assets held by a central issuer. USDC and Tether are examples of these. For every one stablecoin issued, $1 or the equivalent is kept in bank accounts or in safe liquid investments. The idea here is that because stablecoins are collateralized by real-world assets, they will maintain a stable value as long as the issuer is trustworthy and transparent. Keep in mind that for this peg to remain, the issuer has to safeguard and segregate the funds backing the stablecoins. There are other types of stablecoins as well. Algorithmic stablecoins attempt to hold a steady value using financial algorithms and smart contracts. Commodity-backed stablecoins are pegged to assets like gold. Crypto-backed ones use other crypto as collateral. In recent years, some of these stablecoins have suffered high-profile collapses, so we're only going to focus here on fiat-backed stablecoins. Let's now talk about how stablecoins work under the hood. At their core, stablecoins are pieces of individual digital code that run on blockchain networks. They use the same distributed ledger technology that powers cryptocurrencies like Bitcoin or Ethereum. Most popular stablecoins are issued on public blockchains. For example, USDC is an ERC20 token on Ethereum, and USDT exists on multiple chains like Ethereum, Solana, and others. This means every stablecoin transaction is recorded on a transparent, tamper-evident digital ledger. If Alice in London sends 100 USDC to Bob in New York, that transfer is confirmed by the blockchain's network within minutes, or seconds depending on the chain. The transaction can also be seen publicly. The transfer is instant, traceable, and final. It's much faster than waiting for an international bank wire to clear. Stablecoins are made up of smart contracts, self-executing code on the blockchain. This manages the creation, transfer, and redemption of the coins. And this code ensures that the token supply is always backed by the appropriate collateral. Stablecoin transactions occur peer-to-peer. To move stablecoins, you just send them from your digital wallet to another wallet address. No bank needs to approve it. It's a lot like sending an email of money to an address. And it can happen 24/7, 365, so you're not dependent on a bank's operating hours. Stablecoins are also starting to serve as bridges between financial institutions. In 2023, Visa piloted settling transactions in USDC instead of the usual bank wires to speed up cross-border payments. It successfully settled millions of dollars in USDC between its partners like WorldPay and Nuvei. It demonstrates that major payment companies are using stablecoins as an alternative rail for moving real money. Stablecoins are arguably the killer app for cross-border payments. Sending money the traditional way through corresponding banks can take many days, with each institution adding fees and processing time. Stablecoins change that equation. They enable near-instant, low-cost transfers across the globe. A business in Brazil could pay a supplier in Nigeria directly using USD stablecoin, who then converts it to local currency, using instant settlement at a fraction of the cost. According to research by Andreessen Horowitz, sending $200 from the US to Colombia via a stablecoin costs less than 1 cent in fees, compared to around $12.13 using traditional remittance channels. That's a savings of over 99%. As we've moved beyond national borders to employ workers, stablecoins have become an effective payment method. Companies can pay salaries or contractor invoices in USD stablecoins, and workers can hold the value to dollars to convert to fiat when needed. This avoids hefty international wire fees and delays. And crucially, it shields the worker from exchange rate volatility and high banking costs in their home country. Major fintech apps are adding support for stablecoins. For instance, PayPal and Revolut now allow users to buy, hold, and send stablecoins. Brazil's Nubank introduced support for USDC, seeing a 10-fold increase in customers holding USDC last year. In some regions, regulators have begun to accommodate the shift. The UAE, as an example, has taken a crypto-friendly stance in its economic-free zones. In 2023, a court ruling in Abu Dhabi even permitted salaries to be paid in crypto, including stablecoins, establishing a legal pathway for crypto payments. The regulation for stablecoins is evolving worldwide. In the European Union, a sweeping regulatory framework called MiCA, or Markets in Crypto Assets Regulation, was passed in 2023 and rolled out in 2025. MiCA creates a unified set of rules for crypto across the EU member states, and it has specific provisions for stablecoins. It ensures larger issuers with significant volume meet capital and liquidity requirements. In the United States, regulation has evolved more slowly, but there have been multiple legislative proposals to establish guardrails for stablecoin issuers. The industry expects a stablecoin and crypto proposal to pass over the next 2 years. Other jurisdictions from the UK to Singapore to India are developing their own rules. For example, some countries are exploring bank-like licenses for stablecoin issuers or integrating stablecoins into existing e-money frameworks. Stablecoins represent a convergence of traditional money and emerging technology. But as discussed, the potential benefits are immense. Instant settlement, global reach, lower costs, and financial inclusion, to name just a few. In the next few years, stablecoins will likely become as common in finance as email is in communication. I hope this session has demystified stablecoins and you have a better understanding of what they are, how they work, the regulations, and the practical ways they're being used in payments.